Okay. So last week we looked at chapter 16. And we got up to the point of, I think, the conversion and when we have convertible bonds. And the other piece we needed to look at was earnings per share. So today we're gonna look at the earnings per share piece and we're going to look at chapter 17. So, like I said, we want to be able to do a midterm next Saturday. And so that would be chapter 15, 16, and then to chapter 17. But to do that, I want to be able to do at least a review before, like sometime this week, like an extra class where we do a review. So it'll, if I do that, I'd have to be Monday or Thursday evening. So I don't know how persons are for those days. Monday or Thursday evening. Okay. Anyone, what about Thursday?
Nothing.
Okay. So,
Oh, sorry, I thought this was the list.
no, they have it there. So what to do is. All right, so it can be recorded because it can be Zoom anyway. So whatever, I think, whichever one is the majority. Then we'll do it on that day. I'll put it to a vote in the Google Classroom, so whatever the majority is. And we'll do a review. I kind of favor the review on Monday, just because you'll have more time to review with your work. Today I'm going to post all the solutions for the chapters so that you have all the chapters. You understand?
Huh?
You understand?
No, my daughter. Because of that, we have a function to do.
So, are you very right after? So, I kind of favor Monday, but I know someone have a class, but I'm favoring that just because you have more time to work with it, and if you have questions, you can come back to me. So normally the format of midterms that I do are like this. It's gonna be like, hello.
That's fine, they try you in this little room in the back here.
Come on, if I could record from here.
You know that wrong, right? Morning, y'all.
Morning. So we want to be able, I normally will do like 40 multiple choice questions. And then I'm thinking 2 problems.
This for the midterm?
Yeah, I want to do it on Saturday, next Saturday.
What night Saturday is?
I can't remember the date. It's February
25th.
25th.
I am not going. Yeah, I probably have to do it early, maybe Friday, I have to come after work.
Okay, so I'll have to coordinate that with
Yeah.
All right.
Come after work on Friday.
So we are talking about doing a review class either Monday or Thursday, so I'm definitely favoring Monday to do it.
Okay.
So I know one person couldn't do it Monday, but I'll make sure it's recorded. I think, Miguel uploads it on the site. Does he upload the?
I asked them for.
And it's not
email on
consistent.
Monday and I still haven't.
Okay,
So
let me
going
deal with that
multiple choice
today.
and 2 questions?
No problem.
Two problems, yeah,
Okay, so the multiple choice basically could be like
the 3 chapters,
that's chapter,
15, 16, and 17,
okay,
right? We doing 17 today,
okay.
and then it'll be
Like terminology, so,
terminology, things that like any terms. Sometimes the multiple choice you have like little questions, like what is, like we did shareholders equity. So what, like, if you had a question that says, what is total capital stock, and you have a list of things, right?
Okay.
And like those type of small calculations, but not like the big calculations can be in the problem,
okay,
right? So, and then this chapter we can do earnings per share from chapter 16 today. And then chapter 17 we doing as well. There's a couple of things I can focus on chapter 17. 17 is investments. But part of it, when you study, you could study the theory, because it talk about derivatives, and y'all don't need to know, I mean, for this level, I wouldn't say you need to know the book derivatives and options and things, that's like get into another space. So we'll talk about investments. So that chapter for the exam will focus more on the theory than big problem. So you could kind of say you ain't getting a big problem off of chapter 17.
okay,
It'll be more multiple choice, but I still want to go over it. So I normally take questions from the chapter homework. So today I'm gonna post
you
this.
made an exam,
Yeah, so I normally take a homework question, and that becomes a problem or a combination of 2. So it's important you do the homework. I'm gonna post the solutions today for the homework for chapter 15 and 16, whatever I assign. So
Okay.
you'll have the solutions. Okay? So, that means if you haven't submitted it before today, I can't really take it after that. Once I post the solutions. Okay?
I sent you mine last time.
Yeah, I saw some, before you came, I said I saw some coming through. I shouldn't have been on my computer, but I saw it coming through, so. There you have that. Any questions there? Okay. So the last class, we talked about conversions and convertible bonds, and then convert to preferred stock. And we didn't really get to warrants or the earnings per share. So for the warrants, there are 2 methods that the book discusses, the proportional and the incremental method to deal with warrants. So the main thing that I want to emphasize with warrants is that some key characteristics. So normally warrants, they are given to, and this is stock warrants. So we get the definition clear. Normally, you see it as compensation to executives. Or employees. Sometimes it's given to existing shareholders. And this is normally on a preemptive basis. So when we say preemptive, so preemptive right to purchase. And then 3, as an equity kicker, as you can call it. So normally, big companies, they want to reward staff, and this way encouraging staff to make sure the company does well, because they'll participate in the profits if they get shares. This, you tend to see this happen because you want to make sure that existing shareholders do not get disadvantaged. If you issue more shares, they will get them as a preemptive right, so they'll maintain their proportional interest. And then 3, this equity kicker, this is really to make your offering more attractive. So if you're issuing bonds or preferred shares or any type of or doing any type of issue, just knowing that you could have stock warrants attached makes it attractive, because not only am I getting the security, but I getting this right or the certificate, because this is a certificate. That allows me to purchase the shares, so this will give me the right. So I get the right to purchase at a specific price. And period. And that's really a big advantage, because if your stock is trading at $1,000 per share, but you give this person the right to buy it at $50, that's a big deal. That's a big advantage. Normally, especially with the compensation to execs, they put a clause in there where if you buy it, you can't sell it after, you have to hold it for a certain period of time. Because you're not getting it to go and turn it over, you're getting it to hold, right? So they're the reasons people tend to get stock warrants. So when we look at the warrant itself, it could be issued with a security. Okay. Or it could be detachable. Meaning that it can stand by itself. So this means that it has a fair value. So you could actually attach a value to the warrant. So when we actually do any bookings for warrants, we will, from the accounting point of view. So this is the accounting. There are 2 methods that can be used, right? And this is the proportional method. And the incremental. So both of these are methods. Your textbook goes into more detail in the calculation of the proportional method, and there's some narrative on the incremental method. So this is the one in terms of entries where the focus is. Okay. So for this type of, so if we issued stock warrants to existing shareholders, we don't require journal entry, so here is no entry. Okay. And, normally when you have these type of things, we just do a memo. So we know that they have the right, but there's no actual entry in the books where value is recognized. You find this instance with value when they attach the bonds, right? That's normally where you see stock warrants attached. For compensation to executive and employees, there is a value that's attached. So there is an entry here. Okay. So this entry, this would be entry, because normally this will be attached to bonds, so it'll be entry here. But no entry. Whereas an existing shareholder, you just give them preemptive right. Right. So when you see it as part of compensation to executive employees, we normally look at it in terms of a stock option plan. So you'll see a company, they have a stock option plan, and they'll say, once you do so many years and you've vested, you can get an option to buy the stocks, our stocks, the company stocks at this price for this period of time. If they do a value at that point. Yes, and the value is connected to your compensation. Right? Because instead of them giving you a bonus, they giving you this right to buy the stock. So there's a value, because between the value of the stock on that date they granted and the price that you are going to get it at, that creating a value for that right. So on the day they say, we're going to grant you this right, the value of the shares on the market is $150, but they say you could buy, so this is the fair market value of the shares, right? But they say you could buy the shares at $50. Okay, so this is the cost of the employee. So you have a value in there of $100 that you forego by giving this employee the right. Right, because that's the date they are granted the right. And so there's an entry to, and this one I'll show you the entry here. So when you have the stock option plan, they have these sophisticated models to calculate the value. Because you don't get you have it over a period of time when you could exercise. It's not, okay, you just gotta buy it on this date. It's normally a period, and then once that date passes, then it's gone, right? So most people, they buy it. You find most persons buy it. So like I said, normally the employee is vested. Everyone knows what that means. Everyone sure, yeah.
The employee already been there like over a certain period of time.
Yes, so most companies define their vesting period for like a pension plan. You are vested once you've served 5 years or 4 years, you could participate in what we contribute. So normally you'll see this offered to vested employees. And they have, like I mentioned, now they have pieces of it where you have to hold the shares for a particular point in time. I think I mentioned the last class, there was a big hurrah a number of years ago. This happened a while back. The Commonwealth Bank, and they had shares that they offered employees, and there was a scheme, alleged scheme, and all these people got together and were selling these shares who were staff, and Securities Commission got involved in all of that because there were charges started out. So normally they design a way to prevent that type of behavior. where you get it, you are a loyal employee, you care, you have an interest in the company being successful.
So that was illegal for that, all of them to do it.
Yeah. Cause they didn't, it was. The way it was done it wasn't, anytime you do, I always tell people, how do I know a fraud occurred? Or how do I know something I'm doing is not legal? Well, if I can't disclose it to my company, or I can't disclose it to people involved, that is the first sign that maybe what I'm doing is not right. Right, I contributed, because if it didn't, I could say, oh yeah, I sell my shares. But what was alleged, and I say alleged because I can't remember the results, is concluded now, because one of the people was fired, I think, or they resigned. Something happened, but what they did was they colluded and had a scheme. So you exercise, whether or not you had planned to, you would do it on this promise that you're gonna get this for this amount of shares. You buy the shares, we can buy it from you at this price. Because people wanted the shares, right, in the market. So normally there's some sort of contingency on how long you hold it. And so normally when we have stock options, our journal entries will be like this. Okay, so this with these warrants that are okay. So the date is granted. So the date I grant you them, there'll be no journal entry required. Okay, then we have so this one is related to your, where there's a contingency for you to work a period of time. So once you have vested, so this is the end of your service period. Okay, so you vested. Then you will have an entry where we have compensation expense unpaid in capital. Stock options. Now, keep in mind something, you didn't exercise it yet, right? It's just saying that, one, it was granted on this date. Two, this is the, now you have deserved the right to be given these options, right? So you did the service period, you vested. So this entry will just record the value of the stock options, and that value, normally, there's a pricing model, like I said, right? So if you had a question like this, that would be given, whatever the value is, because they use it's called Black-Scholes model. It's a particular model that is used to calculate the value, right? So the value will be given here as to what these stock options are worth. So this service period. So we haven't exercised anything yet. So then, when we actually exercise it, so we exercise these options to purchase. Okay. So we are buying it from the company, so the company is gonna get cash. Right? Then what else would we have? If we go back to our old model, what we have down here, if now you exercise and you're giving out shares.
Common stock and paid in access.
Yes. So you get common stock. Okay. Right? We're gonna get rid of this. Because we had set up the options here, so when you exercise it, these options don't exist anymore. Right? Everyone see that? So I had done this entry here. So now I have to bring that account to zero, so I have to debit it, paid in capital. Stock options. Right? And this here, additional paid in capital will be where any excess goes. Right? So we know what the common stock number will be, because that'll be at par. We know how much cash they'd pay, because we'd give them a price to say you could exercise this option. Say we told them they could exercise the option at $50. Right? Common stock par value is 10. Say we worked out this value is 20. Right? We'd have 20. 50, right? Then we have common stock $10 par. Because I doing it based on one, and then the difference go into additional paid in. So that's 60. Okay. So this additional paid in capital stock. Paid in capital stock options, this account, you'd have to be given the value, like I said. You'd have a fixed price that they say you could buy it at.
Which is a fair value.
No,
No?
this the price that they agreed in the stock option. Remember now, you got the option, you got the right to buy it at a price. And normally that price is below market. Because if I
Okay.
giving you an employee the
Yeah.
right to buy stock, I'm not giving it to you at market. I will give it to you below market. So it's a advantage. So what this piece doing is bringing it, should be bringing it to market value. You see that? Because we given the stock option a value. And we saying this how much really is the value, because that's how much less you paying than if you had to go there and buy it on the market. You see, so that's what this model that's calculating this is trying to capture. Because if you were a regular person going to buy stock,
It would have been at a higher price,
it'll be at 70.
but they give you the option to buy at 50.
And then this amount here is the value of that option, that right,
When I calculated,
which you did.
no, I was looking at one of so I mean, one of the questions I saw. So
Okay.
what I did is I actually, it was like $50, and I think it was like 65.
Mhm,
It was offered to the employees at 50 and 65.
mhm,
So I took the difference from that, which would have been 15.
mhm.
That's what I did.
To get what? The
The,
15 would have represented the value of the option,
yeah, I think.
but that would have been, that wouldn't make sense. Because what this doing is the value of the option. Right? But I just want you to understand the steps
I
here.
understand it there, but I.
Yeah. Because I want you to know the theory behind this. If you were to get a question on this, like say multiple choice, I want you to know what the entry is gonna be. Because I know these values, these would have to be given, right? And then when you get here, right, this will be in the stock option plan to say what price you could get it at. Right, so this is what happens when it's exercised. Okay? Now, you may not use, all employees might not take the option, so there's another step, right? And so that's for where, okay, so there's some options that expire because the employees don't take it. So where we have expired options. We have to, we're not going back to this entry if it's expired. Right? We don't like reverse it or what have you. What we do is we say, paid in capital. Stock options. As debit. And on the credit side, we say. Paid in. Capital. Expired. Options.
That's the credit.
Yeah. So that's, this is debit and this is credit. So that's the fourth thing. So you grant these options. At the date when persons earn the right to have it, we record this compensation expense. And we recognize the value of these options. Then persons are gonna exercise it. We should see this entry when they exercise it. Some are not, so some are gonna expire because the period is passed. And then there's one more thing that happens. So that's 4. So the fifth thing that can happen is you'll have persons who forfeit. So normally this happens if someone leaves the company. Right? Before this vesting date. Right? So what normally happens here, we just have to adjust this entry. So where we might have had it for, say if this was for 1,000 and someone left. And say their amount represents 500. We would do entry to just adjust it for that amount, so we'd have paid in. Capital. Stock options. And then compensation expense. And so say that was 500. 500. So now what will be left in this account should just be 500 here and 500 in stock options, because we took out the people that left and forfeit their right, okay? Okay. So. Everyone good with that? Wanted to spend some time on that, so it is the compensation plan. So the last thing I'm gonna do from this chapter is, earnings per share. What's the shortened version when we say EPS? So what does, what do you think earnings per share measure?
The profit,
Measure profit in what way?
what you would need,
Mhm. So it's income per shareholder. So if I was to divide the income amongst all the shareholders, that would be, if I had one share, that's how much income will come to me as a shareholder if we stop the company today. right? Just how much I would have earned for the current year. So when we look at the earnings per share, we looking at it. When we do that ratio, we are saying how much would each shareholder get? How much would they share in this current profit? We decided to liquidate it.
So you said you divide that by,
So I'm gonna put the formula in a minute.
Okay.
I'm just gonna talk about it a little while. And so it is a ratio that people look at a lot. So normally we calculate it and we call this simple. Because there's a complex version. So we have simple earnings per share. So net income minus.
That's
Net
the
income.
formula, right?
Yeah, that's the formula. Preferred dividends. So weighted average. Number. Of shares. So anyone's annual report you could look at, they have this calculation on it. And normally you'll see it right after the net income, or they'll have a page with a bunch of ratios in the annual report, but. Normally, when you see net income, this will come at the bottom of it, net income, this earnings per share calculation. So that's the simple, that's the basic. So weighted average means that, and for the purposes of this class, normally when we do a weighted average, we take the beginning and ending shares outstanding. And that's important, is the ones that are outstanding, not authorized. So that's where those descriptions matter. So remember, we said we have authorized, we have issued, and we have outstanding. Outstanding is what we consider the active ones. So whatever was outstanding at the beginning of the year, plus what was outstanding at the end of the year divided by 2 will give us an average. That's how we get our weighted average. Now, there are many models for doing that weighted average. Sometimes people calculate the average daily because they trade in a lot of shares. So they have a daily weighted average. Some do it weekly, monthly, whatever. But for the purposes of what we're doing, you just have the beginning or the ending. That's what you'll normally see in questions, right? The other thing I wanted to note here, so, you know, preferred shares could be cumulative, right? So we only factor in here, not if they have 20 years worth that's outstanding, whatever would have been paid currently. So we know what would be paid currently, because dividends would have been declared. Right? You only declare, only when you declare a dividend that you actually say, hey, I'm gonna put it on the books. So that's important to know. Sometimes you may see it and they say, oh, they owe dividends for 5 years to preferred shareholders. You don't go put 5 years worth. You put based on whatever's declared. And they actually say they're gonna pay.
They pay once a year.
Not automatically. If there's no income and none is declared, they don't get paid. But what'll happen whenever a dividend is declared, they have to be paid for all the years that have been outstanding if it's cumulative.
Okay.
So this just says preferred, but if it's cumulative, that's the other thing you have to keep in the back of your mind, right? So any dividend arrears, we don't include it. If this is a loss, so instead of net income, so say we had a net loss, you'd have net loss plus preferred dividend. Divided by the shares. Okay, so that's if it's a loss. So that's so why this could be tricky, is you could have treasury that you buy during the year. You could have stock dividends. And you could have stock splits. All those things could change this number here. So that might look similar thing at the beginning and then, no, that could, these three little things, they could make that look complicated, right? So there, that you also have to keep in mind when you do the calculation, right? What is the average? So normally, when those things, when these occur, these two occur, we normally treat it as though it happened from the beginning of the year. Okay. When we look at treasury or if we issue new shares, we have to work out, we have to weight it by fractional period. Okay. So say if I had 10,000 shares, right? I had them 6 months. Then I issued 5,000. So that add on to that. Right? So I had 5,000 more because I added 5,000 more. Maybe, so for 6 months, I had 10,000, I added 5,000 more. So this came in at month 6. Then I bought back some. Month 9. And then at the year end, I have 12,000. Right? So when you have this type of issue purchase. So when they say wait by fractional period, you have to do a weighting to say for 6 months, I had 10,000, right? For 9 months. Sorry, just a minute. For 6 months, I had 10. For 3 more months, I had 15. Right? Because at month 6 is when it came. So up to month 9, I had 15. Right? So I had, if I did this on the scale, so 0 to 6, 6 to 9 months, 9 to 12. Right, so I have 10,000 shares, 15,000 shares, and then 12,000. Right, so I'll have to use that fractional of the year to work out my weighted average. Right, and if I add a stock split or stock dividend, I have to take it from the beginning of the year. So this could be complicated. If you know, when you're doing these sort of calculations, you really have to sit down. If your company is doing a lot of movement, normally.
Oh,
This-
there's no question like that.
I have to teach you it. This is part of
That's
to
fine.
awareness, right? This could be a multiple choice. How do you do the weighted average, right? You should know. This would take too long. Like you always think about exams. They give you nothing to take too long. They want you to get the core principle. There are much more things to deal with accounting wise than to deal with that. So this is, again, this is our basic earnings per share. So now we have one that we term the complex. Right? So we call this diluted earnings per share. So we call this diluted because we have to factor in all those convertible securities. And we have to think about if they were to convert to common shares, what will be the impact of that, right? So for our diluted earnings per share, we get again net income minus the preferred divided by the number of weighted shares minus the impact of convertible securities. Okay, minus the impact options, warrants, other diluted securities. Okay. So that's this big one here. So really what, the objective of this is to say, what if all these things got diluted? What would that do to my earning per share? Right, and investors want to see what will be the impact of this, what we call dilutive behavior. Right, if everyone exercises their options and warrants, if everyone converts their securities over IF bonds, and now I converting it to common stock, how is that going to impact my earnings per share? Mhm. So that's what I'm gonna leave that. And then I'm gonna go to chapter 17. So I encourage you to read your text. Because they talk about, the theory behind it and all of that. I'm not getting that deep into the accounting here, because this is like we do tables and different things which they have in the textbook. But I think this piece is the most important to know the difference between the simple and the complex. Appreciate that the things that impact this weighted average. You've already done the work on convertible securities, so you know what will cause something to convert, right? The types are susceptible, so you have preferred stock as well as bonds that could convert to common stock. We also talked about the options, warrants, any other securities that could dilute this as well. Because the minute I give you options, when you exercise it, that creates shares, right? So all of that is gonna impact the diluted earnings per share. So just without putting any numbers to it, we could all assume that this will be lower than this, the minute we add all these things to it. So if you have a company and they like to issue all these type of securities, that's not gonna work so well to an investor who really wanna participate and getting dividends and all this earnings, cause they're gonna have to share it with more people down the road. Might not happen today, but there's an impact to them. Right? So that's why this matters. We're not just doing it for calculation's sake, but this matters down the road. Okay, so that's the end of chapter 16. I can take this off, right? So chapter 17 kind of continues, but chapter 17 is investments. So now we're back on the asset side. So investments being investments that you, the company, makes. So you could invest in different types of securities. So you can invest in debt securities. So this is investments. It's on the asset side of your balance sheet. Okay. That's very important to keep in mind, because you could have debt, but you borrowing money. This is where you are the lender, so. But you're doing it for investment purposes, which means, what's the difference between if you do something for investment versus fixed assets or inventory?
You would earn a profit more with the investment part of it.
You could, it doesn't mean you have to. So you have a core business. So if your business is banking, let's use that one. How do you earn your money from banking? What else? That is the main one. Interest, right? From loans.
Yeah.
So your business is lending.
Mhm.
So if I saw that you made money, but you're not making money from lending, but you made it from investments, is that your core business?
No.
Right? So this is normally when you see investments, this is not core business unless you're an investment company. Now, if you're an investment brokerage firm, this is what you can be doing to make money for people, right? You manage in your own portfolio if you're an investment firm. But a regular company is gonna have investments because they might have excess cash. They may be doing it to for advantages down the road. So I might be a shoe company, but I invest in a company that makes rubber because I need rubber for my shoes. I might have a small investment in a rubber company, and down the road, I might take control of it. But right now I have like a 20% or 30% investment because it might be an advantage to me down the road. So these investments, anytime you see investments, one of the things to keep in mind, this is probably not your core business. So if you were to look at, someone just was talking to me the other day about Bank of the Bahamas financial statements, and they say, do you realize Bank of the Bahamas is not really making money from banking? They're making money from investments, right? Which is not good. Because that means their core business isn't doing good. And if those investments fail, they're in trouble, right? So so this is normally not your core business. So you have investments, so you can invest in debt securities. Right? You could invest in equities. Right? And we can drill deeper down in those type of securities. What else you could have? And then you could have what we call derivative type investments.
Can capital expenditures be investments too?
When you say capital,
Capital meaning that, with the monies that you have already, and you just wanna use that capital to expand your business. Further investment.
okay, so let's walk that back. So when I think of capital investment, sometimes I think of plant, property, equipment, yeah. You talking about capital investment for profit. So say if I bought a building,
Long term, no.
yeah, so if I bought a building, say I bought land, this is a good, because I've seen this one. So sometimes a company, a bank is gonna buy land. Right? Nothing to do with their core business. It's investment purposes, because maybe they thinking to build a branch 10 years from now. But they're not doing it today, so they hold it. So it wouldn't be with their fixed asset, plant, property and equipment, it'll be investments. You could do that. Right, that's an investment. That'll be considered investment. So we have debt, we have equities, and then I'll say other. So the other will be those type of things. Land. Whatever, or things the person might decide to invest in art. Some people invest in their artwork. Like if you go in a institution, they have artwork and it costs a lot of money. It might be an investment because they only holding it to sell, not to keep, right? So these type of things, we're not holding it to keep forever, right? And there's a plan down the road, but it's not related to our core business. So let's look at each one. We can look at each one in particular. So under debt securities, we put them into 3 buckets. So we can have those, we can hold to maturity. The ones we trade in. Okay. And then what we call available for sale. Right. So anyone can give me examples of what this will look like, hold to maturity, what'll be a good example of somebody holding to maturity, this is that. You could use our current environment. What would be also? Maturity. Not government bonds.
That'd be relevant.
So that's like government bonds. So normally you see big pension plans, companies invest in that, long term because the returns tend to be high. Government is supposed to be secure, we have a stable government, and normally you hold them to maturity because they are matching against your long-term mortgages, other things that you have on your books. If you are a bank, if you are, doing some other type of activity, you may invest that just for the return. I have a company right now, say they trying to move all there, they have about 600,000 in cash and time deposits that they trying to move now to government treasury, because one of the time deposits is 0.11%, 0.011, let me get it right, 0.011.
So if
And
they
the
move that time account to government security, you think the interest rate would be higher on it?
Oh, yes, yes.
Like how much it is now?
Well, it's what central bank will grant the interest for, right?
Yes, you have government bonds out there, if you bought it off someone, some are at 6%.
But is it fixed?
Yeah, like you
Yes.
get it, you buy it in blocks of 1,000. And they have different maturity dates. Oh, when you see the government issue, all these companies trying to grab them up to like that's water, because that's a big, that interest rate is huge.
That's the government issued bond.
So the other deposit they have is like at FinCo, and that is 0.0075. So their board was like, hell no, get rid, put them in something else.
Up to 0.025, I think for that. Hey, how about a high interest rate too, strategy in a minute.
Well, see, credit unions have a different purpose. right? So I was just reading a book on, budgeting and finance and stuff at a personal level. I like to see what new tips, and they actually say, if you have a savings account, go to a credit union, right? And the good thing here, central bank regulates them now, so they just can't do that stuff. They have to have good governance, but they offer higher rates because they are not competing in the same way the bank is doing what they're doing. So they share dividends and all of that with holders, so that's a good thing. Like I didn't have a account, but that's something I said I definitely have to do. Have account at credit union, but theirs is better.
In saving.
Yeah,
Savings is like,
yeah,
it goes up.
yeah. And then you could borrow there at lower rates.
Yeah.
So it's very popular, especially with government, public service workers, that's
Oh,
their
they do.
thing. Yeah. So. They tend to be the ones held to maturity, you have the trading ones, so these tend to be short term, so in the US, they have T-bills, which are short term, you can get 3 to 6 months. In our local market, sometimes you have small ones like that may be available. And then if your debt security doesn't fall into either bucket 1 or 2, then they are characterized available for sale. That's how it works. Okay, so that bucket happens if they don't fit into 1 or 2. So let's talk about these a little bit, because some of these should be familiar. So from the accounting perspective, when we look at debt securities, what are the things we're gonna be thinking about when we record them? So the biggest debt security we have dealt with is what? Bonds, eh? So when we have bonds as investments, what are we doing there? What are some of the things we gotta think about? We have to think about amortization. So although we on the asset side of our books, we think about amortization, because we might have bought it at a premium. Or a discount. So when we invest in debt securities, we have the same type of recording, but just now on the other side, right? So before we would have had, when we issue, we'd have cash. And we have bonds payable. And on one of these sides, we'll have unamortized discount or we'll have here an amortized premium. If we bought at a premium, if we issued a premium, we issued a discount, we'd have an amortized discount here. So this is on the liability side if we issue it, right? Now we on the asset side. So we on the asset side, we paying for it, right? So we are here. So this is the debit. This is on investments. These are investments. And we paying for it. Right? So we might buy something at a premium. So we have our bonds payable. We don't call it bonds payable, we have bond investment. Okay. This is a receivable. This bond investment and unamortized bond premium. And if we have a discount here, we would have the discount on this side. Right? So what I want to emphasize here, we have these same things we have to record. If it's on the asset side, it's an investment. We're gonna have premium and we're gonna have discount depending on the market price and market value. So that normally applies to these securities that are held to maturity. If we holding it to maturity, we're gonna have this. Right? Now, when we get into trading, no, we still on that. When we get into trading securities, so they're the ones, debt securities that are held to maturity, right? So when we get into the ones that are trading. These are reported at fair value. Right. So when it's trading, it's short term, we're not getting into all those different amortization, all of that. We record in at fair value. So when we record things at fair value, we're gonna have an unrealized gain or loss. And it only becomes realized when we actually sell it, right? So the data sale. We can realize a gain or loss. So for these securities, there's gonna be a price on the market. So there's the price today. It can be a price tomorrow. So at any period end, like month end, quarter end, whatever the price is, if the price is higher or lower, we're gonna have an unrealized gain or loss. And the date we sell it is when we realize the gain or loss, okay? So that's very different than when we holding it to maturity. Right, a question?
Yeah, so the unrealized gain or loss, isn't that amount amortized, like, let's say on a monthly basis, so if you do know? So how would you, because you said at the date of sale, the
Okay,
unrealized.
so I give an example of one, so I buy. So I buy bonds, and these are ones that I trade in, right? And I buy them at a price of $96, right? And say during the year, I say at the month end. So let's say 31st of January. That price is now 90. And then I sell it in February for 98. So if I treat that as a security on short term, when I record it, what do I have? I have a bond investment, right? And so I bought 100 of them. Okay, so my bond investment gonna be how much? This is a debit, this is on the asset side. 100 times that. That's simple. What's the other side to this entry? For what? I bought it with what, cash, right? Yeah, so I have cash. So January 31. My price went down. Right. So I don't have an unrealized what,
Yeah.
right? So where does that go? A loss is what, a debit or credit, right? Where would the other side go?
On the credit card.
Mm-hmm.
And that'll be the date of sale, right?
No, this month, we start again. We write down the asset. Okay? So right now, the asset means what? Okay, because we decrease in this value here. So I bought it at this price. At January 31, the price went down by 600, right? So I have to write down this investment. So I include it in a T account. So I have my bond investment. And I have I started with 9,600, debit. That's the value of my investment right now. Everyone see that? So this January 31. So in February, so that says February 15th, I sell. And the price is $98. Right? I always take out what I put in. So I sell it now, so what I'm gonna get in my hand. Yeah. So I sell my 100 98. So 9,800 in cash. I gotta get rid of this, right? Cause I get
9,000.
Cause I sold it. And this difference to 800 is what? There's a credit. Right? So it's unrealized until it's sold. And when you actually sell it, you have a realized gain or loss. So there's a realized gain, right? It's on the credit side. Because I realized the gain. This is the investment in the bond, and this is cash. So when we have a bond, or equities or any type of security, we treat it at a fair market value. We just look at the price. What's the price today? We price everything in our portfolio. This is the price. What is our unrealized gain or loss? That's what we have to book, right? When we sell it, then we realize a gain or we realize a loss. So that security, so that's securities we could hold to maturity, we could have short-term trading, the ones that are available for sale. We also treat these fair market value. So here where we hold it to term, this is where we get into discounts and premiums, because we holding it to the term. So equities. So when we have trading equities, so equities, we can have the ones that are trading. So trading equities are gonna be at fair market value. Right? However, for accounting purposes, equities get a slightly different treatment depending on how much we hold, right? So. Okay. So this is equity. Investments. So equity investments are in common share investments in a company. Right, so that's specific, it's not just, okay, this is, you have shares in another company. Right, so we treat these a bit different. So we say if you are holding less than 20%, you can use the fair market value method. So the same thing you just saw me do with the bonds, we invest in the bonds, the market go up or down. You're gonna recognize at a period end, unrealized gain or loss. At the date of sale, you recognize a realized gain or loss. You do the same thing with the equities. So this is with, 20%. Make sure it's clear, there's 20%. Less than 20% that you hold in this company. So we have a lot of accounting around this piece right here. So then if you have between 20% and 50%. We use what we call the equity method. Okay, so that's 20 to 50. And then if you have more than 50, you have to consolidate. So more than 50, you got to get their financial statements and you have to combine it with your financial statements. Okay. So there's a whole cost, just consolidation. We have the equity, which is between 20 and 50%, and fair market value, which is under 20%. So the easiest one is this fair market value, because you don't have to, all you worry about what the current price is. Equity method goes a little deeper, right? And we're going to talk about this one some more. And then on 50%, we consolidate, right? We combine their financials with our financial statements. So let's talk about this equity method. So equity method, this has some unique characteristics to it. Generally, and what's driving this is that accounting is saying that under 20%, you don't control the company. This is just speculative, you're just trying to make some money, this is short term, blah, blah, blah. When you own between 20 and 50%, you have a certain degree of influence, but you don't control it, right? So we feel like you have more vested interests. You have influence, but not to the extent of control, but you're significant owner, right? And you probably participate in decision-making, right? And all of those reasons put together, you have to use the equity method. So in your text, it's going to give you some requirements, because it's not just the percentage. We look at significant influence, right? So significant influence, is something we actually measure. We ask questions like, do you have representation on the board? So if you are on the board, you have representation, do you participate in policy making? Do you have any type of technology dependency? So I used the example before with the shoe company and on the rubber company. A lot of companies do this thing where they have an interest in their supplier. Because I will make sure if I'm making bags, I control in the leather company, so I get certain quality. You can't just do whatever you want, and sometimes I want to do it where you cannot provide that to another, that particular commodity to someone else. So you, when they talk with supply chain, you control the chain from your food store, from the farmer, the truckers, shippers, right to your company.
People would invest in all of that.
Yeah, they do it here. Look at, when you look at financial statements, you should look at financial statements, some of the companies here will shock you. So I'll use Commonwealth Bank because this is in the annual report. They have about 6 companies which they disclose. So they have an insurance. So that's why you buy a loan product, you get an insurance from them. All the types that you need, right? So they controlling, they have a real estate company, like a holding company for all the land, all the stuff that they have sitting over there. Then they have an investment arm, right? Because they have to invest in equities. So all the little pieces. So you start, so say that it'll be for the government to restrict how far someone could go and so you'll see certain, like in pharmaceuticals, I think one time ago, the government tried to prevent. If you are a wholesaler, you can't do retail, so that's what they did with insurance. So that the big insurance companies like Bahama First can't have a branch to sell you insurance. They have to use a local broker. So that broke up the market. This happened 5 or 6 years ago. So you see all these people they'll say, I sell insurance for Bahamas First, so I sell insurance for this J.S. Johnson. So it'll be hard for me to go.
Or they underwrite, but I mean.
Yes,
Okay.
That's what they.
yeah, yeah.
They underwrite.
So I use the wrong terminology,
You know,
but before you could do it directly.
We only have really two,
Yeah.
here, which is, I think, Bahamas First, and I think that's on the right. Just all of them.
Bahamas First is Nassau, right? If I
Okay, so
recall
all
it.
of them have. So when you ask them for a quote and stuff like that, they still have to go to,
All of them go into the UK, right? Because Lloyd's and these different big ones are underwriting their big portfolio. But locally, like if I went to someone agency right here, right? They are representing someone else. Like they're gonna say, oh, well, we represent Generali. Generali's not gonna have a person just come like they in their office, you're not gonna have a Generali person talk to you. Right, so they have the market set up in a particular way where I don't know if it's like, because I've never sat down and studied it to see if it was fair or equitable.
but you mean, because you have like for example, an insurance company I used to deal with name of response agency,
Mhm.
right? So therefore, they still have to go to Bahama First in order to, so when we got our insurance certificates and stuff, it had
Mhm.
Bahamas First on it and not response agency.
Yeah,
So they were acting like an in-between person, so, yeah. I
so
understand.
that's a recent thing. That wasn't always like that.
Okay.
Yeah, they changed it. So a lot of companies, this what you can see. Where they controlling the third party and intermediaries because they want control the whole chain. So you may be thinking like, say, and I'll use the food store realm in our country. So you may be thinking, oh, I go into not a food store, I like pharmaceuticals for this one. You think you go into Lowe's, right? And you're gonna bring in something from away, but they controlling the wholesale, the retail, And because they doing at such bulk, when they go like to the States or somewhere, they control and sometimes even it come into the Bahamas, so that big person away say, no, I can't deal with you because laws have the contract. And this is where you talk with significant influence, because it could be a significant partner, you just don't have shares, but you are an exclusive partner.
Yeah, they just trying to lock in the contract, so nobody else could get it. So once they lock in the contract with these other companies, they already, when somebody.
They
else
can
tries
own
to
the
do
market.
that, they control the market.
So you have that like, a lot of people don't realize John Bull on Subway, they own, what you call it?
They call them jumbo group of companies.
Yeah, John Bull Group, right? But they own a number of
Starbucks.
Starbucks, right? Because but see, with theirs is very aggressive, because when you're dealing with brands, right? You have a brand store, that brand store is a store on its own. But they have interest because they have a contract to say no one else could get it. Right? So that's where these things get heavy. And you want to know what the interest, so when I look at someone's financial statements or their annual report, I always like to see what they have significant holdings, because they have to disclose it.
Then somebody else, the guy just died too. Who had-
Myers.
Yeah, the Myers group of companies, and he had a bunch of companies, too. Burger King, wow.
Yeah, so this is important, because when they doing their statements, you have to figure out, do I do equity or consolidated, or am I here with this 20% investment? That's why this is a big deal in accounting, because when everything was accounted for here, you didn't see what people controlled. All you know, they had shares, they buying and selling, but the accounting now force you to show these two. And it force you to put it in your books here. We're not gonna do this one like, this where we're gonna spend a lot of focus for the purpose of this class, but this one is where you really see the player. I used to work for, this is a long time ago, for British America, and I actually this is all I did right here, consolidation, and they had, that's when they owned Fidelity's, the British American Bank, they had the insurance, and they had something else, they had like 3 different entities. They were the first one before Colina that had all these entities doing different things. And they had branches all in the Caribbean and Africa. And so this used to be that's a job by itself, because you have different currencies and you have to consolidate everything into one. So for big international companies, this also is critical for people to see, because they could see what you're doing globally. And what type of player you are, because that could get interesting too. So equity, right? So we know you have to have significant influence, and you should be owner between 20 and 50%. So this is a good place for multiple choice, because you got to know what significant influence is. Excuse me. So under the equity method, what the equity method does is say, I own this interest. So for my books, I'm going to recognize my proportional interest in your company. So that means when you have a profit, I can recognize 20% of the profit. If I own 20% interest, I can recognize 20% of the profit. I'm going to recognize dividends. And that's how I'm going to value my investment. I'm not going to do it using the fair value method. So what does that look like? We're going to have an example. Go up to the top. So we have stuff that happened. So January 2nd, ABC Corp. they purchased 55,000 shares. And that represents 26%. For Wendy's company. And they did this at a cost of $8 a share. Okay. So when that happens, we'll have an entry here of equity. So this January 2nd. Equity investment. We'll have our $8 times our 55,000 shares. So we get 440. The other side is cash because we paid cash for it. Okay. So no issue, we bought it, investment, just like how all the others work when we initially buy it. We have equity investment and then the cash, 440 debit, and we have our credit. So the next thing that happens, and this is where we start very, this getting different, is say, so say this 2017. So at the end, 2017. Wendy's Corp. They reported net income of 250,000. Okay. And ABC company their share of that times their 26% is 91,000. So this company that they invested in, they purchased the shares here. They got 26%, so that means it has to be equity method because it's between 20 and 50%, right? And at the end of 2017, Wendy's Corp reported net income of 350,000. So their share of this income is 91,000. Okay. So what do we do with that? We have to record it. So in our books, we can have equity investments. $91,000 and investment income 91,000. Okay. So here now, this is not fair, but this is not fair market value. This is equity method. Because they own between this 20 and 50% ownership. On significant influence. Okay. So they share the profit. So let's say instead of having that profit at the end of 2017, let's say they had a loss instead. So at the end of 2017, instead of having this profit, let's say they had this loss. Then again, what we would do is take that amount. Times it by the ownership percentage. To get their share, which should be 55,900, and we will record investment loss, equity investment. No. Okay. Okay. Everyone good there? Yeah, so this our investment, this is what happens if they have income. The company we invested in have net income. This is what happens if they have net loss. So the last thing that we're gonna look at is if they have dividends. Okay. So early 2018. When this company paid a $75,000 dividend. So again, what we do is work out our share. So we say 75,000 times 26%. So our share of this should be 19,500. So what we'll record, because they declared dividend, that means we getting cash. Right, they giving us cash in our hand based on our investment. We're gonna get 19,500. And then equity. Investment, 19,500. Right? So, very different than fair value method. If this was the fair value method and we got dividends, we just have cash and dividend income. But under this equity method, because we have that level of ownership and influence, we gotta record the dividend this way. Right? Now, one last comment just on all these type of securities, whether it's debt or equities, is that at any time, if we know the value is impaired, and when we say impaired, there's a significant loss in value, we have to recognize it right away. So, and give an example. Say this company we invested in their operations in Abaco, and Dorian happened, and they got devastated. We'll have to write it off because you may say, well, they don't have any value. Right? That's impairment, that's significant and permanent. So, this would be called the equity method. We recognize proportional interest in income, in losses, and dividends, and everything is affecting the equity investment account. Now, the last thing I'm going to touch on, when I say I touch, is derivatives. Okay. Everyone knows what a derivative is. Any idea? None? I mean, none of y'all investing in that? All right. So derivatives. So make sure you know the definition of what a derivative is. If I use layman's term, this represents an underlying security. Right? And normally it doesn't require little initial investment. That's normally. And normally too, it requires or permits net settlement. So some of the traditional securities where we would have derivatives are futures and options, right? You see them talk about interest rate swaps. Futures, people buy a option, and that gives me the right to purchase something in the future at a particular price. I could buy options and futures against security prices, against commodity prices. The underlying security will be a commodity like oil. Beans, whatever the commodity is. And the reason people do this is the hedge price. So you hear in our local conversation about this BPL hedge business. It's because if the government can lock in, or BPL, it's a better way to say it, if BPL could lock in a price right now into the future, that if I buy gas in the future, diesel in the future, I am willing to pay to get it at this price in the future. So what that does is helps me avoid volatility in the market. So the market price go up and down, round and round, but that's the price I've locked in to buy it at, and that's it. So I could win or I could lose, because if the price goes way down, I still paying at that price. If the price goes way up, I win. And that's why they say your advantage is you can make money off of it, right? Because you agreed to buy it at this particular price. And they go into the future. So we don't know what's going to happen in the future. We make predictions, but they sell this as a security. That's the key. A derivative is that thing that they sell as a security, but what is supporting it is something underneath it. So whatever the commodity that it's tied to, that's really what is driving the price or driving the investment value. That's what should be in driving the investment value. So for example, you heard when they talk about these mortgage-backed securities collapse is because the thing that's driving the value that's underneath it, the mortgages, once they went away and they went belly up, then your derivative ain't worth nothing because the underlying security isn't worth anything. So that's why derivatives are so dangerous, because if that underlying security isn't real or valuable, and you are saying it is, then you're selling someone a dream. And these are very difficult to price, and sometimes it can be very complex. That's why I'm not getting into the actual transaction, but I do want you to know what it is. Now, in terms of reporting and disclosures, we have some accounting around it. In the past, accountants kind of dealt with this in a way that they didn't want it to look more profitable than it was, kind of, and whatever the underlying security, you'll try and make sure that value is reflected and all the details around the contract is reflected. So if there are any losses or gains, you disclose everything, so the reader has all the information at your disposal. So again, going back to the whole point of this particular chapter is investments. As a company, you can invest in debt securities, you can invest in equities, you can invest in these derivative type transaction based on your appetite, your risk appetite. And so if I use BPL example, they have some of this because they have the hedging going on, because that's advantageous to their business, because they need that oil commodity, which is very expensive and it fluctuates. They may have some debt because they may have a pension plan and other investments they need to manage. And they may be doing this too, right? Where they want to control some companies that doing business with them. And so, for example, if I'm BPL and I don't, well, we don't do it so much here, but in the States this happens. So I may not want to go and do services to your house and do inspections. I may say, you start a company, we're gonna own 20% interest in it, and we're gonna let you do it, right? But we're gonna own 20% because we could control the service quality. Right, and we will sit on your board because we want to know how you deliver in our service. So that might be where you hold equity investments in companies that may be delivering service to you. They may be a tanker and shipper and all those different type of things. So here, this is another security. So what I'll leave you with here is just make sure you know the details, know what it is. We're not going to so much get into the accounting. But I just want to give an appreciation for what that is. And like any accounting, the last part is disclosure. So all of this will be disclosed in the notes, not just the balance sheet, income statement, cash flow. You will disclose in the notes the method of accounting that you're using, the types of investments that you have, and the changes like gain, loss, and the value that you've invested. And I think that is it there for chapter 17. So like I said, I want to do a review, so it looked like it can be Monday. I know one person can't do Monday, but I'm thinking 6:30 or 7.
I see, somebody texted in the group,
Mhm.
Beautiful said that she had an emergency to let you know, okay?
No problem. So I'm gonna
Okay.
speak to Madam Dean after this to make sure that uploads are done today for all for today.
It stops. He said she had an emergency.
Oh, okay, all right. So we'll plan for Monday, because I'm gonna do a review of these 3 chapters. So all I'm doing, I can post all the solutions today. I have questions for this chapter, but I'm gonna give you the questions with some solutions. And this just to remind you of what we did and to make sure you know the information where you could test yourself. And so when we come on Monday, we going through drilling through each chapter. And then Saturday will be the midterm on those 3. So 2 problems, 40 multiple choice. Yeah.
You can arrange to see. how we need to come
Oh,
on
yes, Friday.
Oh,
Okay.
yeah, how we need to come on Friday.
Yeah, I probably make it all.
Okay, so you write all that down, so I can.
I can't do Friday, because I'm traveling Thursday.
Okay, I'll coordinate with Dan. She can let you know.
All right, no problem.
Okay.
All right, so that's it. for-
Monday.
Yeah, so Zoom Monday.
Yeah. please say-
No, I can send it to you. Yeah,
Thank you.
yeah. So let me write all this down, so I don't forget what I say. Yeah, no problem. Okay. You all send me a reminder. I just like you, all, I have a million, when I leave here, a million things I trying to do, cause once I go home, and then sometimes when you go home, you're so tired.
I
just-
just. Why you gotta shut down like 10 minutes to 12? I was like,